We just got home from the Appraisal Summit in Las Vegas. On the flight home, Brian Reynolds was scrolling through his iPhone and he had in-flight Wi-Fi, so he could do that. A notification popped up about the Fed dropping the interest rate by 0.5 point. Immediately, there were stories of renewed interest in buying homes, refinancing, activity in the market. What does this mean for the real estate market? What does this mean for mortgage rates, which had already dropped in anticipation of last Wednesday's announcement? What does this mean for appraisers? I'm Hal Humphreys, sitting in for Brian Reynolds on the Appraisal Update podcast. Join me after the break. I've got Mark Calabria on the line to give us some insight into what this means for us.
LIA Administrators and Insurance Services, serving valuation professionals since 1978. We provide E&O insurance with a commitment to superior customer service, outstanding liability education, and unmatched claim defense. Visit liability.com to discover how LIA can safeguard your business.
Welcome back. There's a lot of chatter in all channels today and over the weekend about the Fed cutting rates. This is not a surprise. Pretty much everyone expected a rate cut from the Fed, but 50 basis points is a pretty big drop. I've got Mark Calabria on the line with me today. Mark is senior advisor at the Cato Institute. He's also the former head of the FHFA, the Federal Housing Finance Agency. Mark is also the author of Shelter from the Storm, How COVID Mortgage Meltdown Was Averted. Mark, thank you for being here.
Hal, it's such a pleasure to be back again.
You know, you and I had a chance to chat last month at Valuation Expo in front of about 700 appraisers, and you predicted then that we would see a drop in the Fed's benchmark rate. Is this what you anticipated?
I was probably more expecting about a 25 basis point, but there's a degree to which there was a lot of expectation that the Fed would cut in July, and they did not. So this is somewhat a catch-up, if you will. And that's also because why you've seen since July, mortgage rates have already come down about 50, 60 basis points. So when you really started to see that the economic data in July sort of suggests that you were going to see a rate cut, you were already starting to see that priced in. And so by the time we got this cut, it was really in some sense a validating of where everybody was expecting it to go already.
Okay.
So to me, you should not expect after this mortgage rates to fall by another 50 basis points because this one was really priced in already.
Okay, that makes sense. And look, I've done it. You've done it. Let's just clear this up because there's some confusion sometimes with folks listening to the podcast.
Basis point, percentage points.
Basis point, percentage point. What does it all mean?
Okay, for these, a basis point is 1/100 of a percentage point. So, when someone says, let's say if the mortgage rate is 6 percentage points, and you talk about 20 basis points, a 20 basis point increase would be from, 6 to 6.2.
Okay.
And so mortgage rates are now just over 6. In July, when the economic data started coming in and when the Federal Reserve met last time, they were about 6.7. So either 670 basis points or 6.7 percentage points, however you want to think about it. And once that data came in, you start to saw rates decline. And again, where we are today has really incorporated that expectation of 50 basis points. And so for the industry or for a home buyer's perspective, or if you're thinking about refinancing, you're probably going to see another 25 basis points before the end of the year. You're unlikely to see, we're not going to 5% mortgages by the end of the year. If we're lucky, 5, 6. Of course, you have to decide for yourself whether it's worth waiting, whether it's worth refinancing now, whether it's worth buying that house now. Probably by the end of 2025, maybe we'll be close to 5.5. But I do really want to emphasize the big takeaway is this 50 basis point or 0.5 percentage point decline has been priced in.
Okay. So there's a lot of chatter out there in the world about what this means for the broader market in general. What does a drop like this mean for the market?
So let's take different parts of the market. This is going to be good for refinancings because certainly if you've been on the fence, although again, this has been priced for a couple of weeks, but I think it does give you some certainty what direction rates are going. On one hand, it gives you pretty good certainty that they're not necessarily going to go back up. So, if you've been waiting to get back in the water, if you will, either on a refi or a purchase, this is kind of permission, if you will, to go ahead. That said, the primary constraints in the housing market really are kind of tightness in supply. Also have to keep in mind, as I put it this way, while we're never going to go back, or at least probably not the next decade, go back to 3% mortgages, you almost don't want to, because to get to there, the sort of bad things that have to happen in the world are not things you want.
Yeah.
You may look back fondly on that mortgage you got in 2020 or 2021, but you don't look fondly on the reasons why. And where I'm going with this is we're going to start to see further rate declines, but it's also because the labor market is softening, and that's going to be a drag on supply. So the question of, will this kind of will this help gin up home sales? Modestly at most, because you're going to see some demand from the lower rates, but you're seeing a drag on demand from weakening job market. And, at the end of the day, whether you think you're going to have your job and whether you think you're going to get a raise is far more important than 50 basis points to you. And those are the things that drive it. So really good for the refinance market. It's about neutral for the purchase market.
Okay. All right. See, so the refinance market, and I want to talk about that for just a second. If someone can realize a lower interest rate on a refinance and save $300-400 a month on their payment, that's a real back pocket thing.
It's a big deal. And then I should also note, it'll be a real positive for like second mortgages, HELOC market. So, and you won't even have to necessarily refinance your existing mortgage. You could go get that second. So if you've been thinking about doing that home repair or have other needs, you're going to see a pretty good spike. We've already seen a pretty healthy HELOC market, partly because the overwhelming majority of the refinances that went on during COVID were rate refinance for a number of reasons. And so really wasn't a big cash out market. You started to see that in the last year, and this is going to provide a lot of attractiveness again to second mortgages and HELOC. So good for that part of the market.
Awesome. And then my next question on my list was, do you think we'll see an increase in home sales? I think you've kind of already answered that, but let's dive back into it one more time.
Yeah. Just a little bit increase in home sales again, because you're starting to see the weakening demand. And I think the job market is going to end up being a bigger weight on the purchase market over the next year. That's really not going to be fully offset by rate declines.
Okay. But some folks that have been sitting on the fence thinking, I want to buy a home, this little bit of a bump might help them.
Absolutely. Absolutely. I also think one of the things to keep in mind, so the 50 basis point change was in short-term rates. So you've already started to see a steepening of the yield curve. One importance of that is it makes adjustable rate mortgages far more attractive. So I think you'll start to see some of the ARM market come back in a bigger way. But it's also important to keep in mind because I like to characterize as the Fed influences rates rather than the Fed controls rates. And their influence in this case is really on the short end of the market. A lot of the influence that the Fed had during the pandemic was the large-scale purchases of mortgage-backed securities. And that had more of an impact on the long end of the market, which again is where mortgages are priced. And so, we're starting to see a steepening in the yield curve. Again, I mentioned that will be good for ARMs, but it also may mean that you start to see declines in the short end that don't always show up in the long end. It is not a 1-for-1. And you and I talked about this in Las Vegas, that, a good rule of thumb is, if the Fed cuts short-term rates 50 basis points like they did, then you can maybe expect about 30 basis points of that to show up in short-term rates. But there's a big margin of error around that.
Okay. All right, good. All right, so the last thing that I want to talk about is, I'm a real estate appraiser. Most of the folks listening out here are real estate appraisers. What, Mark, do you think this might do to the real estate appraisal business?
Well, certainly a lot of refinancings are going to require an appraiser. So on that end, but of course, unfortunately, for good or bad, a lot of refinances may have appraisal waivers or maybe rate refis. So there'll be some activity that comes about from the appraisal side. Again, because the purchase market will be slightly positive to flat. I don't think you're going to see as much of a kick there. So most of the business is really going to come from the refi side.
Okay.
There may be some where HELOC side you might require an appraisal. But again, this is predominantly for the industry going to be driven by the refi side.
Very good. Mark, I cannot thank you enough for taking the time to be here and kind of give us a real brief overview of what this means for us. I'm looking at your screen right there, and I see this book in the background, Shelter from the Storm. Those of you listening to the podcast, I can highly recommend this book. Go to Amazon, pick it up, Shelter from the Storm, by Mark Calabria. Fantastic book. I actually read the entire thing, which is a bit unusual for me.
Flattered. Thank you.
Fun book to read. Really shed some light on how Mark and his team handled the mortgage business during the COVID crisis. Mark, again, thank you for taking time to be here, and hopefully we'll talk real soon.
Absolutely. Such a pleasure, Hal. Be well, and I look forward to seeing you next time.
Cheers. Thanks. The Appraisal Update podcast is brought to you by Appraiser eLearning.